when an item of asset or liability meet the recognition criteria to be included in the financial statement of the entity, then a value must be attached to that particular asset or liability before it can be in the financial statement. And to get those value for those particular items, then there's a required or there's a need for measurement. Several reporting standards require that the item of assets or liability are measured using the fair value measurement approach. So today we want to look at how to fair value an asset or liability. That is, the accounting standard IFRS 13 prescribed the accounting treatment or how to use fair value measurement in all standards that required fair value measurement for their respective item of assets and liabilities. The objective of fair value measurement, that is IFRS 13, is to prescribe a single source of guidance for fair value measurement of assets or liabilities throughout several reporting standards. Another objective is to ensure comparability between several accounting standards that make use of fair value measurement. Now, the background of IFRS 13 is basically as this. Like I said earlier on, most accounting standards make use of fair value measurement. For instance, if you take IAS 16 or 38, we can see the use of fair value when the asset or the property, plant and equipment or the intangible asset is subsequently measured using the revalued model or revalued approach. In that case, there's a need for fair valuing the revalued amount. So we can see that in IAS 16 or 38, there's a use of fair value there. Again, when we take IAS 40, that is investment property, the subsequent measurement requires that we use the cost model or we use the fair value model. So here again, you will see a use of fair value in there. If we take IFRS 9, all financial instruments are required that they are initially measured at what? Fair value. So again, we can see fair value measurement here. If you take IFRS 7, it requires that anytime we cannot use fair value measurement, then the amount that will be presented in the financial statement when we cannot use fair value measurement must be what? Must be disclosed. Again, if you take IFRS 5, that is non-current asset held for sale, again we will use fair value measurement over there. We will use fair value to measure whether we are using a carried amount or fair value less cost to sell. And then if you take IAS 36, that is impairment, you again have to use your fair value comparing with what your value in use. Remember that fair value measurement is not value in use, neither is it net realizable value. So fair value measurement is not value in use and is also not net realizable value. Now, the purpose of IFRS 13 is to prescribe three things, or is to handle three things. First is to define what is fair value. Second is to set out the framework for fair value measurement. So we'll set out the framework for fair value measurement. So that is the second purpose of IFRS 13. And then the last is to disclose fair value. So once you take IFRS 13, the main purpose is to define what is fair value and then set out the framework. How do we get the fair value measurement of a particular asset or a liability, and also for the disclosure requirement of IFRS 13. That is the purpose of the fair value measurement, that is IFRS 13. So we'll take them one after the other and we'll look at what goes into each of them. When we say fair value, when we say fair value, according to the standard IFRS 13, we are saying that it is the price that will be what will be received to sell an asset or paid to transfer liability in an orderly transaction between market participants at the measurement date. So let's take the items in the definition one by one and look at what they mean. So the first one is the price, and this price we are talking about here is the exit price. So we are looking at exit price. So we say it's the price that will be received. So that price we are talking about, or the price that will be paid, is an exit price. And when we say exit price, we are saying that is the price that will be received to sell an asset or paid to transfer liability. So the price there is an exit price, but not an entry price. So that means we have two types of price when it comes to IFRS 13. So we have exit price and we also have entry price. With the entry price is the price that will be paid to acquire an asset or receive to assume what a liability. That is an entry price. Now again, in the definition, we look at what we call, or we had something like orderly transaction. It's a price that will be received to sell an asset, paid to transfer liability in an orderly transaction. It simply means that those involved in the transaction are not forced or are not coerced, are not influenced to enter into the transactions. And then we also have in the market participant. Market participant. When we talk about market participant, they are the sellers or the buyers in the principal or the most advantageous market to sell an asset or a liability. So we are looking at the buyers and sellers in the principal or the most advantageous market. Subsequently, we'll look at what is the meaning of principal market or the most advantageous market. So they are those sellers and those buyers in the principal or the most advantageous market to sell an asset or a liability. There are some features about this market participant that is very, very necessary to know. So the features include, first, those market participants are independent. They are not related parties. They are very independent. Two, they have knowledge, or they are knowledgeable about the activities that transpired in the market. So they are knowledgeable. That is the second, characteristics of market participants. So the third one is that they are able to enter into transaction for assets and liabilities. So they are able to enter into transactions. They are not forced. They have that ableness. And then the last one, which is the fourth one, is that they are willing to enter into transaction for assets and liability. That is for the features or the characteristics of what market participants. Now remember that the definition mentioned assets and liabilities. But here, the IFRS 13 does not only focus on assets and liabilities. It also provides guidelines for measurement of what? Owner's equity or equity instruments. Owner's equity instruments. Now, having understood the definition of IFRS 13, that is fair value, we say it's a price that will be what? Will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Once we have understood all the things that go into the definition, we want to look at how to measure fair value. So now our focus is setting the framework to measure fair value. Now, anytime an entity wants to measure its assets or a liability using fair value model or fair value measurement, then that particular entity must make use of what we call observable market transactions. Observable market transactions. But in a case where the entity cannot assess or those observable market transactions are absent, then we use the other way around. Remember that the objective of using observable or unobservable market transaction is to establish the fair value of an asset or a liability. So in this case, if you want to get your observable market transactions, then you have to get the active market, an active market. So here we want to look at what is an active market. When we say an active market, is the market in which transaction for an asset. So according to IFRS 13, when we say an active market, is a market in which a transaction for an asset or a liability takes place with sufficient frequency and volume to provide pricing information on an ongoing basis. That is basically an active market. Now, sometimes in this active market, you have the quoted price that will be relevant to measure assets or a liability. So we have information in the active market. We have observable transaction information to value our asset or liability. But in a situation where there is no active market for that particular asset or a liability, then the standard prescribes that we resort to valuation techniques. So if you don't have an active market for that particular asset or a liability, then we have to resort to what we call the valuation techniques that we will be subsequently looking at. Moving on with the measurement, that is, we are still under how to fair value an asset. Then for you to get those observable information, there are two markets IFRS 13 prescribed. We have the principal market and the most advantageous market. So like I said it earlier on, that market participants are those sellers and buyers in the principal or the most advantageous market. Now we want to look at what that the standards say about the principal market and the most advantageous market. With the principal market, we are saying that is the market with the greatest volume and level of activity for an asset or a liability. Now, under every circumstances, the principal market is the market that the entity normally transacts its assets and liability. Then when we are talking about principal market, it does not necessarily mean that the entity must go and go and look or observe to look which market is principal or which market is the most advantageous. In this case, the entity just use the reasonable information available to make that decision. So in the principal market, we are saying that the market with the greatest volume and the level of activity, and the market that the entity regularly transacts its asset and liability is what we call the principal market. But in a situation where there is no principal market, then the entity must resort to the second market, which is the most advantageous market. And when we say the most advantageous market, is the market that will maximize the amount that will be received to sell an asset, or minimize the amount that will be paid to transfer a liability, after taking into consideration transaction cost and transport cost. So here we are looking at two costs: transaction costs, and then we also have what we call transport costs. So before one can determine the most advantageous market, you have to consider transport cost and transaction cost. So what it simply means is that if a principal market is available, then the entity can easily get information on how to fair value each asset or a liability. But in a case where there is no principal market, then the entity must resort to a most advantageous market. With this most advantageous market, before you can use that, or before you can say that this is a most advantageous market, you have to consider the transaction cost and the transport costs. Let's quickly take a practical example to establish the difference between the principal market and the most advantageous market. So assuming that we have this information, we have market A and market B, with the selling price in market A 100 and selling price in market B 105. We have a transport cost of 50 in market A and 40 in market B. We also have the transaction cost in market A to be 5 and that of market B to be 6. Now, assuming that market A is a principal market, is the market that the entity regularly transacts its assets and liability, then market A is the principal market. Assuming the question asks that, determine the fair value of the asset. Anytime we are determining the fair value of an asset or a liability, we don't consider the transaction cost. We only consider transport costs. The same way, if we are determining the fair value in either principal market or the most advantageous market, we only consider the transport cost but not transaction cost. These two costs are there to help us to determine which of the market is the most advantageous market. So in this case, if we assume that the market here is a principal market, then our fair value is going to be what? 50, because we are just going to take into consideration the transport cost, but not the transaction cost. Now, assuming that none of these markets is a principal market, then you have to look for what? The most advantageous market. In this case, we have to look at these two markets and see which one is what? The most advantageous market. We are saying that is the one that will maximize the amount that will be what will be received to sell an asset, or minimize the amount that will be paid to transfer a liability after considering transport cost and then transaction cost. So in this case, we can see that if you look at the final figures here, 59 is the most price, is the highest price over here. So in this case, market B is going to be the most advantageous market. Now, what will be the fair value in this most advantageous market? The fair value is going to be what? 65. This is going to be the fair value. Why? Because we just use the transport cost and the transaction cost to determine which of them is our most advantageous market. After that, if you want to determine the fair value, you only consider the transport cost, which is going to be what? The 40 over here, less from the selling price to get the fair value of 65. That is the difference between the most advantageous market and the principal market. Remember that the entity need not to go to the market to determine which one is the most advantageous or which one is the principal market. What is required of the entity is to use the information that is reasonably what? Available. Now, there are some times that there will be no active or observable transaction information about a non-financial asset. So here we want to look at a non-financial asset. An example would be a vehicle or a trademark, non-financial asset. So here we don't have maybe an active market for such an asset. Then the entity said that we should fair value a non-financial asset using what we call the highest or the best use. So here we want to use the highest or the best use to value what? The non-financial asset. So when we talk about highest or the best use, we are saying that is the use of asset or liability by a market participant that maximizes the value of the asset within which it is used. But anytime you want to make use of this highest or best use, you have to take into consideration three things. The first one is to see whether the asset is physically possible. Is the asset available to be used? Whether the asset is physically what's possible. The second one is that whether it is legally permissible. Is that particular asset being restrained or being restricted to be used, or it is legally permissible to use that asset? And then the last one is that whether it is what? Whether it is financially feasible. Whether the entity can enjoy the economic benefit that is embedded in that particular entity that is what? Financially feasible. So before you can use the best, you have to look at whether the asset is what? Physically possible, is available to be used, it is legally permissible, and it is what? Financially feasible. So we want to look at the initial measurement of asset or liability using fair value. In this case, anytime you want to initially measure an asset or liability using fair value model, then we are saying that the initial measurement is going to be your transaction price, and this your transaction price is going to be the exit price we are going to use, the exit price. So your fair value at initial date is always your transaction price, the amount that you are going to sell off the assets, the selling price, and that selling price in other cases is what? Your exit price. That is going to be initial measurement of any asset or liability using the fair value. A situation where your fair value will not be your transaction price or will not be an exit price, your transaction price will not be your exit price. It's when the parties involved are related, and when we are using different units of account to value the asset, and then when the market in which the transaction takes place is not the principal or the most advantageous market. In other words, the market in which it takes place is not an active market. And then the last one is when the parties involved are forced or coerced. Anytime such thing happens, then we are saying that the transaction price is not our exit price. So anytime such incidents happen in the market, when the parties are not related, different unit of account is used, the market in which the transaction takes place is not a principal or the most advantageous market, then we are saying that it is our transaction price. Initial measurement will not be what? The exit price. Here, if you want to look at this exit price into details, the price that the seller will bring to the market is an entry price. But the one that the entity will come and buy it will be what? Exit price. But the exit price and the entity price are always not the same because of transport costs and the transaction costs. So like I mentioned earlier on, that if you don't have the necessary information to use observable techniques to value our asset and liability, then the standard prescribe some valuation techniques that can be used to fair value an asset or a liability. We want to look at the valuation techniques prescribed by the standard to be used to fair value an asset in a case where we don't have what? The observable market transactions. So the valuation techniques are categorized into three. We have what we call the market approach. We have what we call the cost approach, and then we have what we call the income approach. When we talk about the market approach, we are saying that is the use of prices and other information from the market involving identical or similar assets and what? Liability. So anytime we can use the prices or the information available in a particular market transactions, then we are saying what? We are using the market approach. Here, the methods that can be used, we have what we call market multiples, or we have matrix method that can be used under the market approach. Now, when it comes to the cost approach, we are saying that it reflects the amount that will be required currently to replace the service capacity in an asset. We call it the current replacement cost. So if you can replace that particular asset with what? With the service capacity in that particular asset, then we are saying we are using the cost approach. And the method we can use here is the current replacement cost. Another method, which is the income approach, has to do with converting the future amount, the future cash flows into a single present values, into a single discounted values. What it means is that if you have several cash flows that the asset is going to bring to you, and you're able to discount them to the present terms, you may have more than one cash flows. But if you discount them, you sum all of them together to get a single discounted value. That value becomes the amount of the fair value. That is using the income approach. And the common method that can be used under the income approach is what we call the discounted or the present value approach. Now, the standard does not prescribe that you should choose a particular approach or in the form of hierarchy. No. An entity can choose any of these methods in valuing its assets or liability using fair value. But once you have resorted or you are using a particular method, you are supposed to use it forever. Unless you want to change it using IAS 8. If you want to change it, then you have to apply the information prescribed in IAS 8. So we want to wrap up our lesson on IFRS 13 by looking at input to valuation techniques. Input to valuation technique. When we say input, according to IFRS 13, input, the assumption that will be used by a seller or a buyer or by a market participant to value each asset or liability, including assumption about risk. So the assumption that will be available to value an asset or a liability, including assumption about risk, is what we call input. Now, anytime an entity wants to make use of this input, the entity must maximize the observable input and minimize the unobservable input. You have to remember that the entity must always maximize the observable input and minimize the unobservable input. The assumption that will be used to value an asset and liabilities, you have to maximize the observable ones and minimize the unobservable ones. So let's look at what the standard prescribed by saying a fair value hierarchy. The entity prescribes some fair value hierarchy using the input. That if there is an information about an input in level 1, you can use it. If there is no information about that, you resort to the second one. So this one is about it follows chronologically. You have to follow it chronologically. So with the standard says that we have level 1 input. We have level 2 input, and then we have level 3 input. Alright, so in this case, we want to look at all what the standard prescribed was said under level 1, that if an entity can use level 1 input, if it's not available, then we resort to level 2. That is what we call fair value hierarchy, prescribed by IFRS 13. With the first one, we are saying that they are the quoted price that are unadjusted in an active market for an asset or a liability that can be assessed by an entity at the measurement date. That is level 1. The quoted prices that is unadjusted in an active market for an asset or a liability that can be assessed by the entity at the measurement date. Example would be the share price of a stock in a stock exchange market, or share price in a stock exchange market. That is about the level 1. Then level 2 has to say that they are the inputs other than those listed in level 1. So level 2 are inputs other than those listed in level 1 and are observable for a similar asset or a liability, either directly or indirectly. So they are observable for a similar asset or liability. Here we are looking at identical asset and liability, but here when you come here, we are looking at what? Similar asset or a liability, either directly or indirectly. When we come to level 2, we are saying that they are the quoted price for a similar liability or asset in an active market, or a quoted price for identical or a similar liability or asset in an inactive market or other observable input, and also a corroborated market input. They all falls under level 2. And then when it comes to level 3, we are saying that the unobservable input for asset and liability, then that has to do with forecast, the cash flows forecast or potential forecast. That has to do with the level 3. Then the standard also prescribe certain items to be disclosed. So whether you are using here a fair value techniques, the important thing that have been done in the standard, you disclose them. But one important thing is that you have to check whether the fair value is on a recurring basis or a non-recurring basis. When we say the fair value is on a recurring basis, then we are saying that it is one that is used often or on a regular basis. So every accounting period you use it on a regular basis. Like for instance, if you take IAS 40, but non-recurring is just one that is being applied once. A non-recurring fair value basis is a fair value that is just applied once. It's our circumstances that in an exceptional cases that we have to apply it. And this we can see it in IFRS 5, a non-current asset that is held for sale. And also you also disclose other important information, all the items, all the information that you take into consideration using a fair value to measure your asset or liability. You disclose them in the books or in the notes to the financial statement. So basically that is all about IFRS 13, fair value measurement. Thank you.